Did you know a tax refund isn't a good thing? Right now it's tax season, and if you're like most people, getting a refund after you file feels great. It might feel like a nice surprise or even like you got a gift. But the thing is, it's actually the opposite. And most people are surprised when they realize what a refund actually means. You know the saying, there are only two guarantees in life, death and taxes. I can't help you with the first one, but I may be able to help you with the second. Today, I'm going to be talking about number one, what a refund actually means and what's happening behind the scenes. Number two, why a refund isn't a good thing. And lastly, I'll show you how to make one simple adjustment so you're not overpaying your taxes during the year. But you've got to be careful because if you go too far, you could end up owing a penalty later on when you file. Hi, if you don't already know me, I'm Troy Inoka, a second-generation CFP professional. Growing up in this business, I learned early on that the most valuable money lessons are the ones that are simple and actionable, which is exactly what I'll share with you today. Alright, let's start with the basics. Taxes are mandatory payments made by people and businesses that help fund government services. They pay for things like Social Security and Medicare, education, defense, and infrastructure. Many people associate April with tax season, but taxes aren't something you only deal with in April. You actually pay them all year long. If you have an employer, taxes are taken out of your paychecks every pay period. So if you earn $5,000 a month, you don't see $5,000 hit your bank account every month. Some of it is sent to the IRS before you even see it. That tax withholding is basically a prepayment towards what you'll owe in taxes for the year. Now, if you're self-employed or run your own business, it typically works a little differently. You don't necessarily only have money taken out of each paycheck. Instead, you often send payments directly to the IRS 4 times a year, otherwise known as your quarterly estimated payments. Different method, but it's the same idea. You're paying your share as you go. The tax year closes at the end of the year, December 31st. Then between January and mid-April, you file your tax return. When you file, you're not paying your taxes for the first time. You're looking at what you already paid during the year and comparing it to what you were supposed to have paid. If you didn't pay enough, you owe the difference. And if you really underpaid, you might owe a tax penalty. On the flip side, if you paid too much during the year, you get that extra back. That's the tax refund. That's the key thing to understand. A refund isn't the IRS giving you extra money, it's them giving you back your own money because you overpaid during the year. That's all the refund is. You paid too much and now you're getting back the extra. Now if you're thinking, so what? I don't care. I like getting money back when I file. Next, I'm going to talk about why you might want to reconsider. Let's imagine your total tax bill for the year ends up being $100,000, a nice round number. But instead of paying that to the IRS throughout the year, you only paid $10,000, 10% of what you were supposed to pay. So when you file, you owe the difference, $90,000. Because you severely underpaid your taxes, however, you not only owe $90K, but will likely be charged a tax penalty, which is essentially interest on the amount you owed. The penalty rate changes over time depending on where interest rates are. So far, the logic makes sense. If you severely underpaid during the year, you will likely owe not just what you should have paid, but also interest on that amount. But here's where things get interesting. What happens when the situation is flipped? What happens if you pay too much? You get a refund, but let me ask you this. If you get charged interest for underpaying, why don't you earn interest when you overpay? Now that refund suddenly feels a little different, doesn't it? Let's say you get back $12,000 at the end of the year in the form of your tax refund. That's $1,000 a month you could have had in your pocket during the year. You could have used it to cover family expenses, pay down debt, invest, or at the very least, earn interest on it yourself. Instead, the government got to hold on to it, use it, and give it back to you in April without paying you any interest. When you get a tax refund, it basically means you gave the government an interest-free loan during the year. And those interest-free loans from hundreds of millions of Americans really add up. Now, we don't have all the data for 2025 yet because many people are still filing, and some of them may even file extensions, but in 2024, the IRS issued over 100 million refunds to individuals. In total, all of the tax refunds added up to more than $461 billion. That's a lot of money. Money millions of Americans could have used to pay off debt, grow their wealth, or whatever else. So you might be wondering, how do I avoid becoming one of those people? If you receive a refund every year, the easiest way to fix how much you pay throughout the year is to adjust your tax withholdings from your paycheck. This determines what gets taken out and sent to the government throughout the year. You can do this by reaching out to someone in HR. But it's important you don't overcorrect. While withholding too much from your paycheck is bad, the opposite, withholding too little, is also bad and may result in a tax penalty. The goal is to pay as close to as possible to what you'll actually owe, not too much and not too little. So how do you figure out that number? The simplest place to start is to look at last year's tax return, or the most recent one that you have. That'll give you a pretty good idea of what you owed and paid throughout the year. You can use that to make adjustments for the year ahead. Here's the basic rule of thumb. If your refund was too big, have less taken out of your paycheck. And if you owed a balance when you filed, have more taken out. Keep in mind, you should make small, gradual adjustments. You don't want to swing from getting a $10,000 refund to suddenly owing $10,000 plus penalties. There are many online calculators out there that can help you estimate your tax bill. But if you want a little more accuracy, it could be a good idea to check with a CPA. And there's one thing you should remember. You don't need to be perfect. You just need to get close. And here's why. There's something called the safe harbor rule. In simple terms, the safe harbor rule is basically the IRS saying, as long as you get close enough to what you should have paid, we won't charge you extra fees, even if you owe us money when you file. You might be wondering, what is close enough? When you look at how much you actually paid and compare it to what you should have paid, there are two tests. If you meet either one of them, you're covered under the rule. If you paid at least 90% of your total tax bill throughout the year, you're covered. Or if you paid at least as much as you owed the previous year, unless you're a high earner. If that's the case, you would have needed to pay 110% of what you owed the previous year. So let's quickly recap. First, a tax refund isn't free money. It's just your own money being returned to you. Second, while getting a refund feels good, they're not great for your cash flow. That money could have been working for your family all year instead of sitting with the government. And third, there's a smart way to fix this by making small adjustments and staying within the safe harbor rules so you avoid penalties. I hope this video makes your tax season a little less stressful and gives you something to think about going into this year. And share this with a friend if you think it could help them too. Thanks for watching, and I'll see you next week. Now if you're thinking, so what? I don't care. Do it again?
No,
Now if you're thinking, so what? I don't care. Yeah.